Hello again. So this video concerns people who own their own companies. So this isn't companies like Tesco's, ICI, Shell, BP, which are public limited companies, but small companies which are generally owned by families and people who usually own and run them. Now those particular limited companies, and it has to be a limited company, not a sole trader, because it needs to have separate shares which are classified as separate legal entities, a legal limited company. So the shares could pass into a business shares trust. So why would you? Because most people are aware that their own private limited companies are not liable to inheritance tax. But this is a very, very sensible piece of planning for people who are likely to own their company shares until death. So for instance, you own your company, you may have passed it on to your children to continue running. But if you give those shares across to your children during lifetime, although there is entrepreneurs relief, you would invariably pay tax. And if your children were to get divorced, then of course a fair proportion of the value of that company could pass outside the family bloodline. So for many people, it's more sensible to hang on to the business shares until they die, because A, it gives them a potential income stream. B, it safeguards the asset until they die, and when they die holding that asset, there's no capital gains tax or inheritance tax to pay, because business property relief applies, and that exemption is 100% for trading companies. Now, of course, this is trading companies, not investment companies. So if you own a company which holds property, sorry, it doesn't work. If you own a company which deals in lots of investments or whatever, then once again, it doesn't work. It's only for a trading company. So what's the benefit? So basically, if you own the shares, and what happens is the first person to die, let's say you own the shares 50-50 with your wife, or you own them all together or on your own, whichever spouse owns them, it's not relevant. The shares pass into this business shares trust. Now, because business property relief applies, there is no tax to pay on those shares passing across. Then what happens is that the spouse has got other assets, and if the business owner dies early, would anticipate that there would be some life insurance element built in to protect the business anyway, or from the assets of the spouse. The spouse then buys those shares from the trust, and either she puts money into that trust or she puts an IOU in. In other words, even if she hasn't got the money, she just registers a debt against that trust to buy the shares. She now owns the shares and effectively can do with those as she will. So if she then sells the shares to another company, company or whoever, then the tax liability, of course, would arise on her. But again, entrepreneurs relief and all of those things would apply, and it would depend on what's the right thing to do. But if she hangs on to those shares until her death, let's say, then effectively what happens is that she gets business property relief on those shares because she now owns them. But she's also got a debt against her estate. So let's just say you own quite a valuable company. Let's say it's worth $1 million, and half the value of the shares passes into the trust when you, presuming, as I said, the male person dies first. £500,000 of asset pass into the trust, and the spouse buys those shares. She puts an IOU in, therefore she's still got all the money. On her death, £500,000 debt is owed to that trust, which reduces her inheritance tax significantly. So it's a way of using the value of your company to reduce your personal inheritance tax. This is partly also what I'm saying about understanding this type of advice. to me, why every single accountant in the country isn't doing this with their clients, I have no idea. They simply don't know. So it's a very, very good piece of planning, and for what is quite a small fee of $2,870 including VAT, that's a small price to pay to effectively place a huge amount of assets out of your estate without even triggering any capital gains tax or any issues like that at all. So a great piece of planning for those people who own limited company shares that they're likely to hang on to for a fair number of years. I would say if you're going to be holding your shares for at least the next 10 years, this is definitely worthwhile. So that's business shares trusts. But again, because it's highly specialized advice, if it comes to it, we will be telling you about this individually and specifically as to how it applies to you. Okay, thanks for listening to that.